Hit it.
It's June 26, 2020, episode 86. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we interview trading legend Victor Sperandeo about his fascinating career in the finance industry. Whether it's trading for George Soros or Boone Pickens, Trader Vic has seen it all during his half-century on Wall Street. Join us as Victor tells us what he sees as the endgame for this head-scratching macro market. Then we find out what our resident technical guru, Patrick Ceresna, thinks about the market in his Talking Charts segment.
Then in This Week in Trading History, we'll look back at Nortel. We'll get Taylor to jump on here to share his WTF Clip of the week. And then we cap it all off with the top 3 things to watch next week. So, Kevin, we might even drink some beers along the way. So everyone stick around. We've got a great show for you. Let's get to the interview.
It's not often that we have the honor of having an actual market wizard on the Huddle. So to say that we were excited by this next guest is an understatement. Not only has Victor Sperandeo penned his own trading books, but he has appeared in countless financial publications throughout the years, with the most well-known being his inclusion in Jack Schwager's famous Market Wizard books. Victor, it's great to have you with us today. Welcome to the show.
Good to be with you. Thank you.
So this is a real honor. I was kind of chatting with you earlier and telling you how much, for a young guy like me, your books meant. The books that I went and kind of dug up through my basement trying to find now because they were so important to me when I was looking at it and kind of trying to figure out how to be a trader. And you had written these books that kind of were inspirational to me. So it's a real honor to have you on the show, and I just want to thank you.
Well, thank you. I appreciate your nice comments. Thanks.
So why don't you tell me a little bit about yourself, where you grew up, and how you got into the business?
Okay. Quick story here. I grew up in Jackson Heights, Queens, New York City, and it was about 13 miles from Manhattan. And basically grew up in these streets had 2 family houses. And one street, say I lived on 89th Street, 90th Street, similar houses. There was an alleyway in the middle where cars would come in and park in the garage in the back, and then you go into the house. Well, anyway, there were about 24 houses per street, and these were long blocks, so like New York City blocks, but avenue to avenue, not street to street. So there were lots of kids that played in those alleyways. And mainly it was ball. It was stickball and things like that, touch football to a degree. And so we got to know each other, and there were probably 15, 20 kids my age. They're talking now, let's say, starting at 14, 15. And on the weekends, we all played cards, played poker mainly. Now, for whatever reason, I had a mental acumen for numbers. I liked numbers. Not that I could have been a physicist or anything, but I like numbers. And so I got to be very adept at memorizing odds and things of that nature. So I did very, very well playing cards against these 15 to 20 kids. You know, the allowances in those days, you know, maybe you got 10, $15 or whatever you got per week. So it was very profitable for me, and I really enjoyed it. Now, my mom, who brought me up, basically didn't like this at all because she thought I would go into being a gambler per se, and actually use the reference that I would turn into a bum because usually gamblers you lose. So anyway, I decided to get a legit job to please her. She was a great mom. And I originally worked for Chase Bank for a very brief time. It was the most boring thing in the world. I went to college at night after high school and basically then looked for a job in the classified at the Times. New York Times was the paper to get a job in because they had a big classified. And I looked for the jobs naturally that paid the most. So the 3 jobs that paid the same, which were the highest at the time, believe it or not, 65 it was $25,000 a year, if you can picture that. I mean, I think that's below the poverty level today. But neither in there, the 3 positions were biochemists, physicists, because of Sputnik, by the way, occurring around that time. And actually OTC traders, okay, basically advertised at $25,000 each. Naturally, I looked at the trader job as like gambling and numbers in Wall Street, so I went and I said, I'm going to get into Wall Street. So I started at Pershing, which was a broker's broker. If I don't know even what they do now, I'm sure the name is still there. But basically, they would execute orders for other brokerage firms throughout the country. And they had this position open, which was called not distinguishably a quote boy. So I became a quote boy, where I would pass orders from these wires, they'd come in over a telecom. It was a telex. And I would take the orders and give them to the proper trader that would be closest to the floor to execute those orders. So I did that for 6 months. I went to S&P, and then I found a job as a trader with Filer Schmidt and Company, which was the largest, or one of the largest put and call dealers. These are the old put and calls where you traded over the counter. They were customized. The CBOE did not exist. So I worked for them, and basically it was very creative. You would think of ideas. You would have a whole list of brokers you could call that you obtained by being there, and you would sell them puts and calls. And every time you did, you got paid. You got a commission. So salary plus commission, small salary, but it was a very lucrative job, and it taught me the trading business and how to use options. And then in 71, this was 68 that I started there. In 71, I started Ragnar Option Corp, which was the 27th dealer. And within 6 months, we became the biggest option dealer in the world, according to the Put and Call Dealers Association. They base it on volume. So we did the most volume. And there was a plan behind that. It just didn't occur, but I had some great ideas that panned out. Kind of the Apple of the day, if I can make a reference to a very successful company. But in any respect, and then of course when the CBOE started, we joined them. We did 15% of the volume. We owned 3 seats. We put 3 traders on the floor, and then we did 5%. And then I sold out to Whedon actually in 77. Became a block trader in the Galama stocks. So I was a market maker in IBM and Polaroid and Xerox in those days, Avon, and you name it, those are the Galama stocks, similar to the FANG stocks today, but there were a lot more of them. And after Whedon, unfortunately, I worked there 9 months, never had a losing month. And then they went out of business because they overspent. So I became a professional independent trader, and this was in 78. And I also hired out as a hired gun. A have gun will travel, and George Soros hired me, and Boone Pickens and Lee Koopman. I had a lot of people that used my services, because in those days I was really very adept at trading. And I had a good reputation, so I did well.
Right. So let me just jump in here, Victor. That's just like a fascinating story. What I actually find most amazing is the fact that you were trading options before Black-Scholes, like the formula, even came out. How would you guys price it? What were you using in terms of formulas to decide if something was rich or expensive? Was it a lot of feel? How did it work? And then do you remember the time that you saw the first Black-Scholes formula, and how did that change your kind of thinking about how markets work?
Yeah, that came out in 73-ish. And the way we made, now I was a market maker. I also ran the firm account, the inventory, what we called inventory. These put and call dealers, you were too young for this, but they used to advertise these puts and calls in the newspaper.
Yeah.
And
my father told me about them, and he said that at one point it was only calls. You couldn't trade puts. Is that true?
Well, no, you could trade puts. No,
there was always? Oh.
Yeah.
He's just telling me stories out of school.
the firms bought straddles usually, but we could buy puts and calls individually, but most of the time we bought straddles. And we would sell the put or the call, and then, or we would spec the straddle. And it was just, it was a block trader kind of position. And the way you made markets is you literally, the way used car salesmen sell cars. Of course, they use this thing called the Blue Book today, but the key is you got to feel for what things were worth based on supply and demand. So, and as you know, there were many dealers. As I said, we were the 27th dealer, so it was very competitive. But you'd be amazed at how people adapted to understand what customers would pay and what they wouldn't pay. And it was usually these were 6-month and 10-day calls. That was long-term gains in those days. People would buy 3-month calls or 60-day calls and 1-year calls as well. But the point is you developed a feel. That's the only way I could say it. You understood what people would pay or not pay, and you made your markets based on a combination of what you could buy for a dollar amount and what you could sell and make a spread.
Okay. And so then when they started the CBOE, you were one of the first on there. What was that like? And was it like when they first started trading, was it crickets or was there action right away?
No, it started off relatively slow because people didn't know how to price these things. And they were generally overpriced, by the way. So best be a seller than a buyer. But the point is that very quickly, the traders on the floor of the CBOE learned, how they could lose money in 50 different ways. So the point is we understood the business. So we had a big edge. We had 3 seats. We put 3 experienced guys on the floor, and we could hedge easily, and we kept our business, meaning the OTC, the custom business, because when they first started trading options, it was limited. There were maybe 15, 20 stocks, I don't remember, but it was very limited. And naturally, over the counter, you could buy any stock you wanted. So right. we basically did both, and we were able to hedge, and it was a very profitable business at the time. But eventually, and this is the problem with Wall Street, you get efficiency comes into play, and you get the redesigns come in, and you basically have to alter your strategies because you're being efficiency to death by other people. So in the 70s, the late 70s, that's what happened. We were losing business on our OTC business because everybody was now going to trade the listed options because they were liquid. Once you bought an OTC option, by the way, you generally stuck with it. But the OTC, the floor business, the CBOE, was liquid, so you could buy and sell, and naturally people preferred that, and that was more, again, technologically more efficient. So people went there, so our business declined, our original business, and then we were, market makers, and that was fine, but it wasn't the guaranteed kind of gravy that we had before. So then we made they made a bid for our company people, if you will, and it was a good deal. So we sold out and went to them, and I ran their block trading desk on glamour stocks. They did this by sectors,
So that must have been a change for you, because now all of a sudden you've gone from being an option trader to a stock trader, and you're running the book. And I take it you're trading with institutions upstairs and making block trades kind of in the early days of block trades?
Exactly. IBM, for example, was 600 in those days. I would make 10,000 share markets for a half-point spread. And, it was a completely different business. But the reason they gave me that job was I had the ability to hedge the stock. So if I got hit, I would, I'm kind of risk adverse doing this kind of thing. I wasn't a big shooter, if you will. I didn't play one side. So I was very good at hedging. So I would either short stock, be short some other stock against IBM, or I would buy options on IBM to hedge the position. So that's kind of why they gave me it. It was very successful. Wheaton was very successful, except they overspent. That's why they went out of business. I mean, they came back in name, but it was a completely different business.
So they overspend, they go out of business, and then what do you do? What's your next step in life? Like, where do you go, to the point where you're now all of a sudden rubbing elbows with the famous Coopermans and Soros and all those names?
Okay, well, a little bit before Soros, which was 81, I became an independent trader. I was solicited by, in those days, it was Interstate Securities. They don't sound like a big name, but they were a big southeastern firm. And they gave you capital. They said, here's capital. And you made it, the deal I made was 50-50. So if I won $1, I get paid 50 cents. If I lost $1, I owed them 50 cents. Now, I only gave them 50 cents one time from March of 78 till about July of 86. I mean, I was very good at what I did. I could, it sounds weird for me to say this, but I could print money. I mean, the markets were completely different than they are today.
You were a modern day, you were Ben Bernanke of your time.
Well, I hate to use that phrase. There was a day trader called Milton Leeds who traded for Pershing, and I'd rather be associated with him. But neither here nor there. The point was that it was a very good living. I did extremely well. We had a great bunch of independent traders. Frankie Joe was one of my good friends there. He was in Barron's many times at the round table. And we had about 6 to 8 traders, let's say 8, and everybody made money. I mean, we were the firm. We made more than the firm grossed in commissions. Were you
trading were you trading futures, or were you trading equities, or trading whatever you wanted?
In this case, almost exclusively stocks and stock options in those days. Okay. So, but it was stocks primarily. Interstate was a brokerage firm. So you could trade stocks for, $1 a share. In those days, that was cheap. If you can relate to today, it wasn't cheap. But the point is that, it was a very adept trading business, and you were in and out 4 times a day, generally, and you'd be buying, maybe 50 stocks and 2,000 to 5,000 share pieces going in and out of the markets. It was a pretty aggressive trading firm.
Wow. And so those were the days of the 8s. How much of it was just earning the spread, or was it trying to catch momentum? Like, what was kind of the...
Those were moves that were, you were basically trading the movements through the day. It wasn't momentum. In other words, things would open up. For example, if IBM closed at the high for the day or within a quarter of a point, 99% of the time it would open higher the next morning. So now I'm giving you sort of an odds-on play. You can make a living doing that. Now, if it closed in the middle of the range, it didn't mean anything. But all I'm saying is you were playing the movements of the market as they reoccurred almost always, but not necessarily perfectly. So, people would go out to lunch, for example, the market would go down. Okay. So I used to trade a lot by the clock. So if I was, I was in New York at this time. So I basically, be long in the morning, then I'd start to sell, and then I'd start to go short, and then I'd start to buy back at 130. And, these were movements of markets through their naturally flow throughout the day, but it wasn't based on momentum. Momentum did occur, but if there was good news and the markets were rallying after 2 o'clock or 2:30. Generally, they would close strong, and then you would play that move. But it was, we're talking hours here,
Right.
see, or an hour
And so
and a half.
the markets were a lot less efficient. So just disseminating the information throughout the street, if you were kind of at the forefront of that information, you could actually make a lot that way, I would assume, right? Just by having better and quicker information.
Right. There were no futures at this time that moved the markets. That started in '83. I traded a lot of those, the S&P futures, but that didn't become a business, which most big firms like Goldman and Morgan Stanley, they dominated that business. They learned how to play the game, and basically the efficiency was in understanding the flows of how markets move throughout the day. And
right.
you occasionally got a momentum move, but that wasn't how you made your money. There was no high frequency traders. So there was no competition. It was purely skill and knowledge and experience that made you
right.
Gave you the ability to make the money.
So you were doing this till '86. What happened in '86? Was that just you saw the writing on the wall?
Well, no. What happened in '86? Now, I had a market making business on the side. I mean, I was a hired gun for Interstate, and you traded their money, but they didn't pay anything. You could do whatever you want. So I had a specialist business that I had started in '79 on the Amex. So I had people working for me, and doing this. I was also a specialist on the Pacific Coast and in Philadelphia. And then I hired out to people like George Soros in '81. I ran the short side of the quantum fund. And so I had these other businesses. In '86, what happened was S&P, Interstate went public. And the traders all made money, but the quarterly swings were big. So, and we were very dominant relative to their commission business, right? So what happened is being a PE stock now, quarter to quarter, if the earnings moved greatly, it affected the price of Interstate securities. So they decided, even though we were very successful, to get out of the business because it wasn't conducive to the growth of their stock.
Right, understood.
So
it's tough to put a big. Sorry, I was going to say it's tough to put a big multiple on volatile earnings.
Right. So because again, if it wasn't smooth and growing, the stock would be volatile, right? So again, they made money, but that was what was more important was the value of Interstate stock, the PE, and therefore they decided they didn't want the swings that the traders gave them. Not that traders lost, but let's say one quarter we'd make $50 million. And then the other quarter we'd make $5 million. You see, it would throw their earnings all, crazy.
Right. So they sold you guys in '86. What do you do from there?
Well, I had these other businesses, and I basically, just left managing their money to run these specialist operations. And, I didn't really change much. So I then developed my own trading business like I did with Interstate, and I had 39 working for me at one time, where I would actually teach, attempt to teach, and basically give them capital. And then if they, I never fired anybody. If they lost X, whatever X was, and X was different for each guy, they were terminated.
So you were one of the original prop shops.
Pardon me?
You were one of the original prop shops.
Yes. I did what Richard Dennis did, if you know the turtle story. The only thing is he was he was much more successful than I. I picked anybody and figured I could teach him, and he was far more eclectic. And unfortunately, if you reread my book, the most important chapter is emotional discipline. And that's why I wrote that book the way I did, because you can teach people things. Knowledge is not irrelevant. It's secondary. It's the emotional discipline to carry out what you tell them to do. Meaning the putting in their stops and limiting your losses and things of that nature.
So do you think after seeing the people that were able to follow that or have that emotional discipline, did you start to get better at picking who might be successful and who might not? Or
no.
Really
I basically said you can't teach people. There's no way to because I could teach you everything I knew. It was very funny. In the '87 crash, I was a bear. I was written up at Barron's. That was one of my greatest fortuitous write-ups at the time, because it was 3 weeks before the crash in '87, and I was bearish as hell. Okay, so I was short. I had a reporter next to me, and sure enough, 3 weeks later, the market crashed. So I look like, I was very smart at the time. And all my traders, I had 39 traders, not including me. And I would say probably on that day, 3 made money. So even though I did do very, very well, the firm barely survived. We made money, but barely. And it was because all these other traders, the S&P gapped down at the time 15 handles, which it was 2,500 at the time, the Dow, and by memory now. But anyway, the S&P gapped down, and these traders, would generally buy the dip. I shorted that opening, or even though I was short before, I made $250,000 on a 5 lot in the S&P. These are the big S&Ps. But the point was, most traders bought the dip and they held all day. It was unbelievable. Right. I mean, so there was no stop losses. You see what I mean?
Right.
So I said I was lucky to have made money that day as a firm, even though I did extremely well, because I had to offset, something like 35 guys and women that didn't understand the meaning of the word risk control. Right.
Right.
So they had limits.
Let's just talk a little bit, about that, selling that gap down, because I understand the kind of the instinctual kind of trader would be to buy the gap expecting the gap to fill. Like, that's kind of more common. And I've read different stories of guys that have said they initially bought the gap, but then they realized very quickly it wasn't going to, fill, and they went the other way and they reversed. Now, you had the foresight to just sell it right away. What made you so convinced that Monday morning that gap should be sold and not bought?
Okay. Well, now I do 2 things. I use fundamentals, if you remember my book, and I use technicals. So I try to integrate the 2. All right. That's the key here. Integration. The 2 and 2 equals 4. So if I'm technically bearish, but fundamentals don't warrant it, I'm not going to have big positions. It has to be coordinated. The 2 have to match. So in those days, actually, this was, a big, big up. '87 was a big up year. And then coming into the latter part, this was October, Greenspan came in. He started to raise rates. Now, that's one big, huge negative, right? Raising rates. That's still today the same as then. Then Dow theory, which was something I made a lot of money on in my lifetime, gave a bear signal. And so I used the technicals and actually called monetary theory fundamental, but it was beyond that, because James Baker over the weekend, because we were going into an election in '88, and he wanted Germany to stimulate. This is the reason for the crash, by the way. If you don't know it, but this is it, 100%. And he wanted Germany to lower rates. And Germany didn't want to lower rates. So this was going on for weeks. So over the weekend, he, on Friday night after the call, he said, well, if you don't lower rates, we're going to let the dollar slide. Those were his exact words. He used those words. And that means if you don't cut rates, we're going to devalue the dollar. Well,
Right.
if you were a foreigner and you owned American stocks, he didn't say we're going to devalue 5%. He said we're going to devalue, effectively let it slide. How much it slide, nobody knew. So the great deal of selling that came in were from foreigners fearing that James Baker III, this was the Secretary of the Treasury, and he basically scared the hell out of everybody that owned stocks that wasn't a domestic citizen. And that's why I sold the opening, even though I was short up the gazoo, because it had to cause selling. It was a lock in my mind. So, and I stayed short all day. These were the big S&P, not the one.
Right, and that must be hard because that was a big move, right?
Yes.
What? And what were you ever?
I was a. Let's put it this way: my typical lot size in the S&P was 30 lots. I had been short as many as 500 at one time. This is all personal. So for me to short 5, I'm sort of giving away. If I wasn't, I had lots of puts and I was short other things coming into the day. This was just the gravy. To me, it was a gift. So I shorted a measly 5 lot, even though these were $500 a handle.
Right. Was there any point during the 87 crash in that week where you were actually scared about the system collapsing?
No, never. Because again, the Fed acted. They didn't know what they. I mean, James Baker took it back. The next day, the market rallied. It was. They didn't mean it. They didn't realize many of the market crashes in history came about because politicians said things where they really didn't know the consequences of what they were doing. Kennedy did the same thing in 62. I wasn't trading in 62, but where he threatened the steel industry about raising their prices. And basically in those days, if you look at the chart, 62 was a major, I think it dropped 26% in 2 months. It was biggest. Kennedy proposed in the world of most traders in those days socialism. That was socialism, threatening the steel company by saying you can't raise steel prices. But anyway, the point is they took that back. So 66 was the same. See, a lot of what has occurred in these quick crashes were mistakes by politicians. The biggest one was Hoover in 29 in the Smoot-Hawley bill, and he didn't take it back.
Okay.
That was a big mistake. And then he compounded the mistake by raising taxes in 31, which was really the big deal. I mean, it's both, but it was, and the Fed made mistakes. So that was a perfect storm. But most of these problems come about when people say things they shouldn't say, where they don't realize what they're saying. So I understand most of this. George Soros probably understands it the best of anybody in the world, right? And he understood currencies. That was his game. So when I worked for him, he was a brilliant guy. He truly was probably the best there ever was in currencies. So, but he understood economics, you see. So he understood what would occur, what would happen to countries. So anyway, it was a lot to do with what politicians said, and that was what added to the 87 crash. But they turned it around very quickly, so there was no issue of the system.
Right. Okay. So then you continue on, and what happens for the next decade? Do you continue trading these specialist firms, and how do you make the transition into electronic trading?
Okay. Well, in the 90s, early 90s, I decided to sell all my seats, and I own many seats. Knife seats, CBOT. I own every seat there ever was known to man except the New York Stock Exchange. Didn't own the New York Stock Exchange seat. Not for any particular reason. They were very, very expensive. And I found value in being a specialist and buying Philadelphia seats, Pacific Coast seats. I thought it was overpriced. So anyway, and I used them. I put people there and I trained them, and basically, specialists are a little different than traders, right? Because you have an edge. Now, so in the early 90s, and one of the people I advised and ran money for was Boone Pickens. And he lived here in Texas. That's where I am now, in Dallas. And basically, I used to come here every quarter to 6 months and advise Boone and his team. And I loved it down here. So I sold all my seats and moved from New Jersey. I had a house in New Jersey at the time. And I moved here to Dallas. And I've been here ever since 94. And basically what happened was in the 90s, I was, again, managing money and trading and doing the same things I was doing, but I didn't have a specialist operation. And then I started to develop algorithmic or systematic trading. I was always a discretionary trader, and basically created these systems, which I used based on my experience, and developed these algorithms. And got into that in the late 90s, where I was building these things. And I had a team of quants. I'm not good with computers, so I hired people to do that. And basically, I just created the methodologies. And I've created 2-3+ billion dollar deals. I've created about a dozen $100 million trading methodologies, all again with banks, insurance companies, mutual funds. I had many firsts. ETFs. We had the first ETF on the New York Stock Exchange. We had the first structured note that we traded as a CTI, was what's called HSBC sponsored that. I mean, we traded all. We did these things all over the world. I had about 40 people working for me that were selling these things. And then slowly but surely, when Obama was elected, these strategies started to fail. Now, when I say fail, they didn't lose money. They just weren't making money. These were alpha strategies. So when Obama got elected, he did change America in many, many ways. I can get into that if you want, but I'll just leave it there because I don't want to keep talking. You asked me.
No, I'd love to hear. I'd love to hear why you think he changed America. Let's jump into that, because if you saw, the markets changed, and you think it was related to Obama, I'd love to hear why.
The keys were these QEs. All right, so 208. After 208, they did effectively QE1. Now QE2 was the game changer from a rules standpoint. And when Bernanke did QE2, which he announced at a Jackson, at the steamboat, Jackson Hole. And he basically, it was in late August of 2010. And the program was it didn't become effectual in terms of, if you read the material, until I think it was November 3rd, but you knew it was going to happen in August. So it ended in May of 2011. So here's what happened. He does QE. He basically creates inflation at the same time, because QE creates inflation, right? So the bottom line was that they didn't like that, because now interest rates and inflation had to go up. So this guy, Carl Levin, he comes from Michigan. He's a senator there a long time. He had a brother. Well, he didn't like this more than anybody, and he proposed laws to change it. Part of Dodd-Frank was to change these laws that allowed pension plans to buy a percentage of commodities for their pension fund. Usually it's 5%. But he attributed that to be a reason why we were getting inflation, pension funds hedging their positions. So he changed the laws to make it where if you, as an institution, bought a swap, you have to put up 5 times more margin, so they wouldn't do it. And he basically canceled institutions' ability to hedge themselves with commodities. One of the other rules, just to make it, they take Harvard. Harvard had a big endowment, which they still have, and they would buy derivative products. So one of the things they would do is buy futures, and what happened was they made it such that if you were the manager, the CIO at the Harvard endowment, that you had to become a CTA, or in this case a CPO, a commodity pool operator, to do that. Well, nobody would do that. I mean, why you're running an endowment? Why do you want to be regulated? So you just stop buying that, and you do other things. You buy stocks. You could buy right now your stocks. They were creating ETFs with commodities, so it canceled the demand for commodities. In other words, that was the principle of what this legislation was built on. And then the key one, the critical one, was basically paying interest on reserves, which happened in 2011, late 2011. And, when it first was announced, and I know you know what I'm talking about, right? You guys, know
Yep.
this.
No, I completely,
IOR,
for sure, yep.
interest on reserves. At first, it didn't strike me, which I don't forgive myself for that, because that was the end of inflation. Because what the Fed did by paying interest on reserves was it gave them the ability to do QE, but they effectively bribed, I use that word carefully, the banks to not loan money. And that's why if you Google the St. Louis Fed velocity of M2, you'll notice it today is at 65-year lows, because the banks took the interest they were being paid and they wouldn't loan money. Why would they loan money? Because they got, in other words, to loan money, if the prime rate was 50 beeps more or 100 beeps more, here you got a ride on free money from the Fed. You couldn't lose. You had no capital hits, nothing. And you basically got free money, and you didn't have any concerns about what would happen to you if there was a downturn and those prime borrowers didn't pay you back. So that ended inflation. If you go back to your money and banking days, the way the system works is you loan money, and somebody gets the loan, puts it in a bank account or a deposit, and then that bank takes it and loans it out again. So you get a tremendous turnover of money. Inflation comes from the turnover of money. It doesn't come from the quantity of money, because it can just sit there like, it was for all these years. There was huge money supply increases as the Fed increased their balance sheet, but there's no inflation. Why? Because they paid the banks not to loan the money. And that is the critical reason. And my business went down for that. That's why I'm sure it's right. Because I studied that, but I missed it at the beginning. I said, what is it? What are they doing? But I didn't think about it. I didn't figure it out at the time. And otherwise, I sold my business.
So what do you think is going to happen going forward now with the Corona crisis? We have some big changes occurring in the kind of monetary policy and now, that fiscal policy as well.
Okay, I do believe inflation is going to come back, because now they're only getting 10 beeps on free reserves, excess reserves. So what they're going to do is say, the hell with the 10 beeps. Right now, you can loan money at prime at 4%. So they're going to start to loan money. So there will be inflation down the road, not this quarter and probably not next quarter. But as you proceed, you will get inflation. So inflation is going to come back.
So what do you think the kind of investors should be looking at in terms of strategies to protect themselves if that inflation returns?
Well, be aware of what's going on in the commodity markets. Even though, and then let me give you a number that most people are not aware of. If you use the Commodity Research Bureau, CRB, I use that index. It was created by the Giler brothers. I knew them. And actually, Milton Giler was my customer back in the late 60s. And so I used that index. It made its high on a closing basis in June 2008. It made the intra-month high and a higher high in July. But from its high in July, it's down 69% as of April 21st of this year.
Right.
That's catastrophic in the commodity business. So commodities are at their lows, and now they're coming off their lows a little bit, but not totally. And because there's no inflation, and that's why silver is not moving. But I'll tell you why gold is. But the bottom line is that it's going to come back. So you should follow the commodity markets. You should start to get, really into them to learn about them. Like I say, it's not going to happen until next year, probably. And they're going to continue to do more fiscal stimulus, in my opinion. They say that, and I believe them, because things are not going to be what they think. And so there will be inflation. And that's when commodities will rise, and they're at probably 50-year lows. I mean, it's just outrageous. So
sorry, go ahead.
So,
I'm sorry, I didn't mean to interrupt.
Victor has been an investor in gold, and I fully disclose this. I'm not a trader in gold. I'm an investor. So I bought my first slug of gold, the spot, coins, in '94, and I still own those coins, and then I've added to the position, and my pension plan has an unusual large allocation to gold, but the gold, to ETFs. And then I own silver as well, but I don't own a lot of silver, relatively speaking. But I believe that I've been an investor, and, gold has served me well if you look at it from a long-term point of view. And I paid $412 for it in '94, so you can give you $1,700 now. So the point I'm getting at is there's only one asset that is a lock, in my opinion. Now, I'm talking like I'm a trader, Yeah. The thing is, gold has to go up. And the reason why is, what is the competition for gold? Interest rates, right? That's, if you ask 100 people, why don't you go, it doesn't pay a yield. They'll always say that to you. Well, right now, T-bills don't pay a yield, right? Nothing pays a yield. I mean, 10-year treasuries are probably, 68 beeps or something. So gold is in a very sweet spot here because it doesn't have competition. Now, importantly, in April of last year, not this year, a year ago, Basel III made gold a Tier 1 asset. I'm just curious. Any of you guys aware of this?
Yep, I am aware of that, yeah.
Okay.
They changed it. Most people don't know that. Yeah, for sure. Go ahead. I'll let you explain it. Go ahead.
All right. Well, no, the point is there's no, if you have to buy spot gold as a bank. You buy the gold, right, and then you have no capital hit. So it's like a bond. Sovereigns are exempt from capital hits. So if you're a bank, capital, when you have to set aside capital, it lowers your rate of return. So the reason gold is doing very well versus silver is because silver is still a Tier 3 asset, right? You have to put 50% up if you buy silver. Why would you buy silver? So if you're a bank. So there's a tremendous demand, constant demand from banks, and they see what's going on. They see what's happening with the debt, and they see what's happening with the world economies. So they accumulate gold. And as long as they can put up the cash, which they have to do to buy the gold, because this doesn't count for derivatives, you can't buy a future and do this, then gold has a constant buyer on dips. And meanwhile, China and Russia are also major buyers because they see the handwriting on the wall of this astronomical debt that is being created by the U.S. and elsewhere. So people are putting their money with gold, and they understand it, but there's very few retail that put their money in gold, right? They rather buy Apple. So I'm only saying that gold is to me in a sweet spot. So I would only recommend gold and silver, but silver is not going to move until there's inflation. So that's one to what. Now, it may move a little bit before then, but it gets sold, and these markets are manipulated greatly. The government doesn't want them up, so they sell them whenever they can. But there are buyers to offset these sales.
So Victor, I never thought about explaining the gold-silver ratio with the Basel III kind of requirement. That's like actually fascinating. It's like a very unique kind of way of looking at it. Thanks for sharing that. Another thing you were chatting about before we started was we were talking about inflation, and you had this great stat about inflation over the past century versus the inflation of the past couple of decades. Why don't you share with everyone that?
Okay. All right. Well, if you go back to 1913, that's when the CPI was started to be computed by the government. It actually started in January of 1913. Now, the Fed was passed into law at the end of the year, before Christmas. So you can, if you measure it, I think at the end of the year, and you compound it to date to the April number, which it was published in June, and it was for the April CPI. If you calculate the compounded return, assuming it was an asset for the moment, but it's how much it increased, it would be 3.07% in 106.42 years. Now, just for the sake of this call, gold, which you can go back 5,000 years on this, but gold was 20.67 at this time. So if you compound gold to where I last measured it, which is roughly around where it is now, 1770, something like that, you get 8.03. 4.25. So you're basically saying if I own gold, I would fully hedge inflation, plus I would make 115 more basis points per year compounded over 106 years. So you can imagine that money means that if you invested $1 in the CPI, which you can't do, but if you did, you'd make $2,500 on $100. And if you did it in gold, you'd make about $8,400. But more interesting is from the 70s when we went off the gold standard, because that's really the most relevant, right? I mean, that still exists. So when we went off the gold standard, if you put your money in T-bills, now these are 30-day bills. The way I measure is 30 days. I use Ibbotson Associates, and they're a research firm. If you're familiar with them, they don't have an axe to grind. And basically, you'd make 4.4% by memory. Okay, 4. I know I'm close. Compounded. Remember, the interest rates were big in the 70s, but then they started to come down. And gold makes 8.03. So that's where I got that 8 from. It's from 70. This is from the end of 1970, December 70 to date. And basically, we went off the gold standard internationally in August of 71. So I measured from the end of the previous year. And that's from about 38.9, where it was. The official price was 35, but it went to, actually the official price now is 44.2 or 42.4, I forget. It doesn't matter. It's just an official price. So the bottom line is there is no excuse for not owning gold, because if you were to sell off 2% of your gold a year, you would get a better yield than T-bills, and basically your gold would be accumulating, so you'd have a larger quantity. You see my point? So, but in reality, if interest rates are high, yes, it is a competition of gold, and gold doesn't do as well. If inflation is not rising, if inflation's rising, then gold still does well. But basically, that's why I foresee now no interest rate competition, and basically inflation is coming down the horizon, because the stimulus, or I should say the impetus of banks to not loan money is gone with a 25 basis points Fed funds offer. Then they get paid 10. They get 10 beeps. So they're gonna take the prime rate plus, and they're going to start to loan money. So inflation will come back.
From your lips to God's ears, Victor. So let's talk a little bit about the changing landscape of the stock market. A lot of people have been kind of up in arms about the new generation of traders, and I don't know if you're familiar with this guy, Dave Portnoy, who gets on his YouTube channel or whatever it is. I'm showing that I'm not a young person by not knowing this. Maybe it's Periscope or something. But anyways, he gets there and he talks about how stocks only go up, and this is the new generation and all this kind of stuff. I'm wondering, is this just a repeat of what always happens, or have we hit a new kind of paradigm?
No, since Obama and since they wanted to pay the masters who own the Fed, who are secret, you don't know who they are, they basically are privately owned, they figured out how to move stocks up using QE plus interest on reserves, because again, just to repeat, what hurts stocks is rising interest rates, right? So if you eliminate the interest rates are going to go up through manipulation and central planning, you can drive stocks up as much as you want. I mean, and as much as you feel like doing it, and that's what the Fed is doing. This is from 2008 on, after Obama was elected, you now have a centrally planned, almost 100% economy, and wherever you look, you have central planning. So it's a completely different market. And yes, that fellow is right. The stocks only go up with declines that are, then, short period. And then the Fed comes in and does its dog and pony show, and it gets stocks to go up again. So now what can hurt stocks is, like this virus, an unknown event. And when you get an unknown event that the Fed can't control, that's when you get 35% decline in 25 days, 30 days. Now, what could that be other than what we've seen? Well, how about a problem with Israel and China? Or what about a problem with China? What about a potential war? You see, you can talk about this in a litany of ways. The unknowns are always there. They're just not seen in advance until after the fact. But if there is an unknown event, the question then is, are these stocks valued at reasonable levels? Well, no, they're almost the highest valuations in history, other than the dot-com phase. So if they go down, there's no fundamentals to hold them up. It is truly a bubble. But the bubble can go on for a long time, because the Fed is still blowing air into the bubble, right, by doing what they do. So in general, right now, I don't trade nearly as much because there's no down. There is a down. You can catch and you can make a lot of money, especially if you use options. But the timing is got to be perfect. And if you don't get to see them go down and then rally and get a sell spot, as we used to call it, and then you go short, and then you can, like 74 was, if you look at the chart of 74, you see it went up and down, up and down, up and down. The market was in a downtrend. It was OPEC. It was Nixon. I mean, it was printing money, because all you had to do was sell the rally, and, you use the previous highs, and they never took them out. I mean, it was gravy train. But the key is, today there is no down, because the Fed doesn't want it down. And they're afraid the system will collapse, which it will. It will collapse if they let it go. So, that is why.
Sorry, go ahead. I didn't mean to interrupt.
No. I'm just amplifying. You go ahead.
So I was going to say, is the final end game the inflation that the Fed, finally comes, and then the Fed has to raise rates because inflation? Is that really the only thing that's going to stop this kind of propping of the bubble?
Well, eventually, you're going to have to do this. But here's how I would do it. Now, again, you have to pretend you're the Fed, right? You're Powell at this point in time, and he's not that bright, in my opinion, but you got to pretend you're in his seat. What would you do when let me give you a little, besides, I'm a researcher at heart, okay, so I do a lot of research, but let me give you these numbers before I tell you how they solve for it and what's going to eventually be the end game, because I'm sure it's going to come out this way because it's the only fix. But with the budget deficit this year, ends in September, you're going to have between 28 and 29 trillion at the end of this year. I originally calculated this with 28 trillion. So, which is to me a guarantee. It's a lock. You're already at 26 and a half, maybe close to 27 trillion right now. But usually I look at these numbers at the end of the month. So in 2 days I'll know what the number is. But it was 26 and a fraction the last time I looked, which was the middle of the month. So at the end of this year, let's say you're at 28 trillion. And it could be 29 because they're talking about another trillion in deficit spending. Now, ask yourself this question. What do you think the debt has increased since we went off the gold standard? That's a pivot point because we changed the way the world works. What would you guess the yearly increase in the debt is from middle of, let's say we went off the gold standard in August, from June of 1971. What do you think the debt was then? I don't want to bother you. These are odd numbers. It was 398 billion. That's what it was in that exactly. And there's a website you can go to, the government website. It's called Debt to the Penny. It will show you what the debt is to the penny every day. So if you then fast forward to where we are now, and let's assume you say it's 28 trillion, it's the end of September, the compounded growth rate would be 8.72. That's how much the debt goes up every year from 71 to date, to the end of September. That would be 49 and a quarter years, I guess. Okay. So now ask yourself this question: what is income that the government derives been since 2000, which is it's kind of the modern way the government has collected money. It's, if you count from 99, December 99, you get 2.5 or something like that. If you count from the end of 2000, you get 2%. Okay, so you can, I'm trying to give you, I don't want to confuse you with too many numbers, but the point is, if you took the 2% number and you said, okay, in 10 years, what is the debt going to be and what's the revenue going to be to cover that debt? The debt's going to be 64.75 trillion in 10 years from the end of this September. And that's using the historical number I just gave you, the 8.74. And if you take what the income is going to be, of course, the base was supposed to be 3.6 trillion in revenue. It's going to be much lower, but use that number. Let's be conservative, be liberal here. 3.6 trillion. You would get an amount of money, about 4.8 trillion. It would basically cover 40% of whatever, if you used a 3% average interest rate in 10 years, in other words, the average 30-year and the 30-day T-bill, you add them together, divide by 2. Historically, it's 6%, by the way. And in the next 10 years, let's say it's 3. It may be lower, but let's say use 3. Well, the revenue you would collect, you would have to pay interest of 40% of that revenue. What do you think would happen to the budget if you had to pay 40% of every dollar the government collected to interest? You see, the game is over.
It accelerates.
It's over.
Accelerates. Yeah.
This year,
okay,
this year we're only paying 370 billion in interest. on spending of which was originally 4.2, it's now going to be 8. but the point is, if this is a quick story. So if you go to a loan shark and you say, loan me $10,000, I'll give it back to you in a month, and they'll say, okay, but you're going to pay me a 20% bid. You say, fine. So in a month, you go back to the loan shark. You say, here's your 10, here's your 2. The guy says, fine. And you say, well, can I borrow another 10? Absolutely. You were a good bet. You paid your bill and went off. Now, if you said to the loan shark, look, here's your 10. Can I borrow the 2 to give you? That's when you need crutches to get home, right? You can't borrow the interest. You have to pay the interest. You can borrow principal as long as you pay it back. We still have principal on the books that probably is from the Korean War, right? I mean, it rolls over. So the bottom line is that once the government starts to borrow interest or a huge percentage of the interest, the game is over. Nobody will hold the dollar under those conditions because you're printing money to pay back interest that you haven't earned, right? The tax system is created to stop inflation. That's what it's created for. There's a paper on that, 1945, by Beardsley Rummel. You can look up Beardsley Rummel, and basically he explains what the tax system was created for. But the point is, the game will end when you start to borrow interest as a big percentage of the budget. Right now, it's under 6%. It's peanuts. Nobody cares. Nobody cares about debt, right? Nobody in the markets don't move on debt. They haven't moved. So, but when they will move is when the government has to borrow interest to pay you the interest they owe you. That's when you'll see the dollar crash to no end. So now let's put us back to your original question. How do you end the game if you're the Fed, if you're Powell? You know the definition of hyperinflation? There's an economist definition that created this in the 50s. It's 50%. That's okay. The definition of hyperinflation, right? In 1 month. So, and there have been 55 of these since the French Revolution, 55 occasions. This guy, Steve Hanke, I think he's at Heritage or Cato, one of the two. He has listed these. I have my list too. I've made speeches on hyperinflation. But if you have 30 trillion in debt, as we have roughly at the end of this year, I'm talking December, and you're never going to pay it back, but you can inflate it away. You can do it in 4 months. 4 months at 50% at hyperinflation rates, and then it would be over. You'd have about 10% of the debt left, about $3 trillion, and the rest would be inflated away. So you only need to do this for 4 months. So in my view, that's the end game. It's going to be hyperinflation for a very short period of time. Everybody's going to go crazy, go through the roof. Venezuela's done this now. I mean, they're still walking and talking over there. I mean, Maduro's still, president. I mean, it only takes 4 months. And what happens is 90% of whatever you have in cash is gone in 4 months.
Yeah.
So that's also because it's quick.
Yeah. And that's also your bond position has disappeared, but we won't get into that because Patrick is a big bond lover. Victor, you know what? This has been terrific. It's been an outstanding discussion. One of the things I always like to end with is asking kind of our guests if they could go back in time and talk to their younger selves and give them kind of advice. If you could go see that, young person that was playing stickball in the courtyard, what would you tell him today?
Okay. Well, this would be for the people. There are several companies I'm aware of. Warren Buffett, who is long stocks, right? So I would say that you have to understand politics far more in depth than you do stocks. And the reason is, if you understood that the government won't let the market come down. Now, that hadn't been the case until Obama was elected, because it did go up and down before then. But the point is, to be long only is really the way to have made tremendous wealth. And the thesis to being long only and picking stocks, that's what you have to focus on, not the market, picking stocks, is to believe that the system will never allow itself to collapse. And therefore, that's the one thing I wish I had put more emphasis on, which is understanding politics and understanding that the government will never let the system collapse knowingly. Now, I just gave you a scenario where the system is going to collapse, but only for a short period of time. And once they announce they're changing the dollar is going to be the dollar plus or whatever they're going to make it, I mean, then you sell your gold. It always works in the history of money. So the point is, I wish I had focused more on understanding how the government pays itself and its friends to keep power and the system going. Then you could focus, instead of me being a trader as I've been, you focus on stock picking rather than macro events, because they don't let the system fall. Last point, just to prove this, from 1854, when the NBER, National Bureau of Economic Research, started to measure recoveries and from peak to trough, you had up till 208, the average recovery was 38 months. 38 months. We just ended with 128 months. And if you count from 1982, when Greenspan created all this mess, you basically have about 100 months on average that we have recoveries now. That's game changer there. So my point is, focus. Everybody's got to focus on politics to understand how the system will play out.
That's awesome.
And the Fed
thank
is
you.
controlled by politics.
Well, thanks for sharing that with us, Victor. Real pleasure having you on. I'm going to go reread your book. You've given me a lot of things to think about. If anyone wants to kind of learn more about you, where can they go, and where should we point them?
Well, I have a website which I do just for the hell of it, Trader Vic. And you can look at, basically, I don't sell anything, so it's just a little bit of information. There's some articles I wrote and things I put up there. So, tradervic.com. I have a person that handles that. I don't use my own website, but that's what it is.
Well, anyways, thank you again. It's great having you. And for everyone else, make sure you stick around for the rest of the show. Okay, Lena, hop on.
Hello.
Okay, Patrick and I are both parched. We're going to go right into the beers while you tell us about it.
That's right. So we are drinking Berry White Raspberry Wheat Beer from Sons of Kent Brewing Company.
Too much of anything.
It is an American wheat brewed with a ridiculous amount of raspberries, a deep red color with a wonderful aroma and flavor. I'm afraid to drink this now because I have a feeling it's going to be sour.
No,
it is not sour, but it is raspberry, like, oh God, raspberry AF. Like,
Whoa.
it's just...
Yeah. But it's good, isn't it?
It's like juice.
God,
I feel like I'm drinking juice.
It is. Patrick.
It's a perfect summer drink.
I'm drinking on my patio.
I think you say all beers are perfect summer drinks.
Is that your Kramer expression?
All right.
Oh, God.
Give us our disclaimer here. We got a show to do here.
Okay. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include buyback burns, 5G phobia, and I hear if you take too much J-Pow, you get the Mnuchin munchies. We need like a symbol and a hat, like the. Okay.
All right.
Let's get to the show.
All right.
Talking charts. Patrick, take it away.
All right, Kev. Well, I just wanted to start off with this quick chart of just looking at how the different U.S. indices have performed against each other. And obviously, I mean, it's given that the NASDAQ has been where the leadership has been. But it is interesting that when you really look back, the NASDAQ, which then the S&P has a huge weighting into many of the same NASDAQ names, have been where the performance has been. But then, the Dow is pretty flat for a kind of a rolling 18-month period. And the Russell has been the weakest by far. And so you can really see just by market capitalization how the different sectors have been performing. And it really does feel like the Russell's going to tell a story, because if we see that the Russell rolls over here, what's your take? Do you think that that there's a little canary in the coal mine by looking at the little guys?
No, so I do not think that, but I do think that we're due to roll over. But I don't think that the Russell is telling you that that's necessarily going to be the case. I think it's it's just same chart. It's just not on steroids like the NASDAQ.
Right. And what's interesting is the NASDAQ, the one thing that's worth watching is, I'm just going to break it down to a 1-hour chart, which is we had this one big surge higher on the NASDAQ that started in the middle of June. And we're right now retracing that. In technical analysis, you have these zigzag corrections that typically 50% retrace the prior rises, which is pretty much right here. This kind of 9,800 level, more or less. I'm just rounding, but the key to that when we put on a daily chart is that that's sort of the bottom of this rising channel. And the one thing we have seen repetitively since the bottom was the market sells for about 2 to 3, 4 days. And then the buy on dip traders are back almost immediately and ripping it higher. And while, you were suggesting that there's room for this to give, this is really the big tell. Because, I mean, if with this many days of selling, the pattern has been the buyers will buy the dip right here. And so it'll be really interesting next week to see whether whether it gets hammered and it starts breaking those levels and breaks that channel. I don't want to take on.
I don't want to Gucci your trade, Patrick, but I think the highs are in on the S&P for a little while, and that the next 10%, or at least the 5 to 10%, is going to be lower, not higher.
All right. Well, let's see what happens. I want to then get to the trade that Cuppy has many times Gucci'd, and I'm going to see whether or not the market gods are true, because I'm going to try Gucci it one more time on the other direction. And so with this euro consolidation, I think this is single-handedly one of the biggest intermarket pairs to watch, because what we are, and a lot of technicians will see this consolidation as just simply a flagging formation or consolidation in what potentially could be a big new uptrend. And what the euro does next is going to be the big tell. If this is just a consolidation, even if it temporarily dips lower, if it consolidates up here and breaks out, then the U.S. dollar is going to be in a little bit of trouble. And so this is going to be really important to see whether or not buyers buy the dip here on the euro. Interestingly, when you put this on a longer-term weekly chart, there has been numerous times that this range has acted as a very big consolidation point. And so for the euro to beat this kind of 114, 115 level on the upside would arguably be a key turning point if, and that's the key word, if the euro can pull it off. So the big thing, does it? I don't think so, but do you?
Well, I got a steak dinner on it. So I sure hope it does.
Well, you at least a minimum wanted to kiss 115 so that we're on a plane to Miami and you. Well,
yeah, except that's not going to be happening anytime. I think Cuppy was a master genius when he came up with where he's going to pay for his bet, because that it's going to be years until we're allowed to go into the U.S. again. So it's going to be like by then.
Oh, you can go now. It's just will you be let back into Canada?
We're not allowed. I don't think we're allowed, Patrick.
You can be quarantined. Yeah, I'm pretty sure you can, but you're going to.
No, I think if you're American, you can go back. If you're a dual citizen, but I don't think we as Canadians can go down there.
You can only by air.
Yeah, I know Canadians that have
really
gone. Yeah.
Oh, I didn't know that. That doesn't sound very socially responsible.
But if you come back, I'm pretty sure you're going to be quarantined. Like you have to self-quarantine for 14 days still if you come back as a Canadian. But you are allowed to go. Anyway, so let's go on to some other charts. I wanted to touch on these commodities because it was interesting. I'm going to just use the August oil contract, and it looks like a spitting image of the euro in a sense that. Or even the NASDAQ, where it basically had this little rally, it temporarily broke to a higher high, and is now doing this little 3-4 day consolidation right to these little hourly chart Fibonacci zones. And it'll be interesting because I really think that the euro and the stock markets and oil will either all break or they will all hold and rally off the zone. And this is what's going to be really interesting to watch next week as to whether they all hold the line or whether this all just simultaneously sells. It's interesting. Gasoline broke a little bit to the downside more aggressively on those crack spreads narrowed to like $10. And of course, the big shit to bed one was the natural gas. I couldn't possibly have goochered this worse for you, right?
No, it's God help me. That's an ugly looking chart. That is, and that's like, oh, what a terrible call that was. I liked it and I was wrong. There's just no doubt about it. That's just.
I liked it. I just didn't have any big skin in the game in it. But like, I was wrong.
Just completely wrong.
That's
the fact
why
that we're both saying we're wrong. Maybe we can put it in the bottom. You sell it, Patrick.
That's
just
all right.
Sell it.
I'll sell some. I'll sell some, and
but the market gods know. They know if you just sell a little bit.
So,
you gotta sell it all.
Copper's been holding up though. That's interesting. But what I wanted to, it's so far this channel hasn't broken, but what I wanted to talk about is whether uranium's a buy on dip. And what's interesting about the selling, and this is the uranium participation unit, particularly this is the one that's traded on the TSX. But if you look at that Numerico site, which looks at uranium prices versus the actual participation unit, you can see uranium is actually holding up. The participation unit is kind of selling on its own. Low profit taking, that spread is widening there. What's your take? Do you think?
Well, we have two things going on. The reason is, first of all, the Canadian dollar has been stronger. Which way is it being on? The Canadian dollar is stronger, which makes this go down in terms of the price of uranium stays constant, right? And so that's the first thing. And then second of all, the discount to NAV is basically expanding.
Yeah.
And that's causing
but you buy the dip.
A lot of.
No call? It's okay if you say no opinion.
I don't mind the trade. I don't know if I get all excited about it. I think that
I'm buying dips.
Better things.
All right.
Okay, good. You go ahead. You knock yourself out, bud.
I'm buying the dips. I like uranium. I was saying that the pullback that kind of gives back half of that rally. It's worth a shot. Gold, it's been holding up. Let's not say anything else. But it's so far. And I know Victor was talking about it. But this. If it was a prairie dog, there are prairie dogs that fail within like a day or two. And the fact that we're like going 4 days up here, it's maybe. Anyway, let's not say anything else.
I'm not going to say anything. I'm not going to.
Let's leave it quiet. Okay. What is interesting is though the grains have all been getting hammered. Like look at wheat breaking to 2020 low. Just we got to get the goddess of grain back on here to talk some of these grains at some point. But
I don't know why, because all you got to do is sell them and go away. It's the same as like natural gas. It's just all these. Every
it's
time
ugly. Like look at the break in corn. Soybean has held up a little bit better. But it's nothing. And it's just crazy. They're
gonna be negative prices for grains.
Yeah, but did you look at this rice chart? This is a continuous chart, but like there was this parabolic rise, and then it just goes limit down right off the high. Like I have no idea what happened
is there like
here.
4 of you trading rice futures? Like, who the hell trades rice futures?
The 4 of us. Yeah, that's
exactly.
in the back room of some like little coffee shop.
Like, I didn't even know there was. I think
day trader Dave ain't touching rice futures. That's for sure.
I think that you kind of laughed because you texted me or DM'd me and said, like, you know what's going on with rice? And I was like, I didn't even know there was a rice contract. Forget about that. It's been limit up.
Anyway, but it was interesting because Victor was also talking about that major commodity trend, and this is I'm going to put this on like a weekly chart, but yeah, these commodities have been just getting hammered since that 2007 peak, right? In early 2008 when they all peaked out and then oil crapped out in the second half of 2008. And it's been just nonstop bleeding for the broader commodity space. But if that, everyone seems to have that inflation narrative, but me, I don't see, maybe I'm missing something, but I clearly am. But anyway, everyone's got this inflation narrative, but it'll be interesting because
do you really think that? Do you really think that everyone's got it? Like, do you think that people actually think?
I hear more people saying that inflation is coming than not, for sure.
So if you ask people to give you their over-under on inflation next year.
Okay, let's start doing that. Every person you run into, just ask them the quiz and let's keep a score.
You mean like when I get a coffee, I ask them,
No, I'm talking, you chat with all your trader buddies on your Bloomberg DM shit. Just whenever you're with anyway, whatever.
I would guess, Patrick. I would guess that most people, if you force them to actually tell you what they thought inflation was going to be, they would be under the Fed's target.
Really?
Yeah.
Huh. I wouldn't have gotten that impression at all.
You think that there's more people that are willing to say that inflation is going to be above target?
I do believe one day you will have your day in the sun. You're like a broken clock that's right twice a day, right? Like you can keep saying inflation is coming. One day inflation will come and you'll be right.
Patrick, I just want to say something. I am a 24-hour clock. I'm only right once a day.
Fair enough. And anyway, but it will come. I'm still in the period that we're in this period of.
I don't buy the fact
cycle.
that the argument that people think that there's going to be significant inflation. There might be a chance that people think that there'll be more inflation than the past, but I really don't feel that there's a lot of kind of expectations built into there. Here, I can tell you what the market tells you. Let's just go look at what the market thinks 2-year inflation is going to be. Let me just pull it up. We can settle this.
And while you're doing that, I just want to point out on this chart. This is the S&P GSCI Commodity Index Futures chart. The point I want to make is I would not be shocked still in this year if we went to retest those lows or make a lower low, but I do believe we're on the verge of a turn in the commodity markets. I do believe a commodity bull market will come out on the other side of this, but I just don't think this is it yet. I don't.
So, Patrick, the reason you believe that everyone is forecasting inflation is because inflation expectations on the 2-year have risen 180 basis points over the last 3 months. So it feels like people are anticipating more inflation. Having said that, Patrick, the 2-year break-even rate has gone from negative 100 basis points to a whopping 85 basis points.
What?
Yeah, so I just don't see the markets anticipating any serious inflation.
Well, you're definitely not seeing it in the 10-year yield. I mean, we're at spot 6.4. Like what? Yeah. You and your bearish stance, just egg on your face all day long. It's just not working for you, you know.
Well, I'm not that bearish right now. And actually, I'm neutral, which is like hugely bullish for me.
All right. So I think that this is the canary in the coal mine. If your little correction of the next 5-10% move is going to come around, it's going to come with yields breaking. I think we could see 50 basis points again on the 10-year.
Patrick, that's a given. And that's when I'm going to be just pulling out the pinks.
Oh, Jesus. Okay, that's enough. All right, but what was interesting, the junk bonds seem to be rolling. and that should go with the equity markets. There's a correlation.
Jay's not buying enough.
He's not. He's
not buying enough.
Powell's got to fire up the press and get more junk. The Hertz needs to sell some more.
Yeah.
Brr. Anyway,
you do that well. You're good at that.
I can't do it. Anyway, so I think that's enough for now. But it'll be interesting to see whether these moves. I think there's a lot of things all lining up, and they're either all going to go or they're all going to bounce, and shouldn't take more than early next week to find out. And so this is definitely the things to watch on the charts anyway for next week.
Okay, Patrick, it's time for This Week in Trading History. What have you dug up for us?
Well, we're going to go and do something a little Canadian, so all our non-Canadians can sit back. But many people may know the name, though, but it's the rise and the fall of Nortel. So Nortel Networks was a Canadian public telecom and data networking equipment manufacturer, and it was one of Canada's oldest technology companies. And at one point, it was the ninth most valuable corporation in the world, employing 94,000 people, right? So even though a Canadian company made it into the top 10, it was that big. Yet even titans fall, and over the course of 9 painful years, Nortel became worthless, crushing the portfolios of many pensioners and retirees in what was one of the largest corporate failures in Canadian history. So what brought down Nortel was a lack of vision, C-suite arrogance, accounting fraud, and most importantly, greed, both by executives and their bonuses, as well as willful blindness by shareholders who thought stonks only go up, buddy. And so before we get to the fall, let's talk about its rise. So Nortel became the mechanical department of Bell Telephone Company of Canada and was incorporated in 1895. Speaking of which, Kevin, did you know Graham, the Alexander Graham Bell?
No, it's a little
maybe
before my time.
Yeah, I don't know, because maybe the reason he invented the phone so he could call you late at night and ask you how your short bond trade is going, right? Like you got to keep the lines of communication open. But anyway, so Nortel went on to produce back in the 1900s all these gramophones. In World War I, they made portable switchboards in the field. They went on to make electronic appliances like toasters, stoves, and washing machines. And during World War II, they made radios, radar systems for ships, planes, tanks, including equipment for the Royal Canadian Navy destroyers. But what actually brought they actually did bring real value to North American markets. And it's funny because you could build quality stuff for 75 years, but in the end, that's not what you're remembered for. So it reminds me of a street joke, right? And a guy walks into a bar all upset, and he orders a beer, and the bartender says to him, "So, what's going on, buddy?" And guy goes, "I spent my whole life building bridges. You see that bridge there out the window? I built that bridge. With my own 2 hands. But they don't call me William the Bridge Builder. No. But one time you fornicate with a sheep." Except in real life, Nortel, and it was Nortel and the sheep was the shareholders. I probably went too far, but anyway, it was in 1997 when John Roth, the new CEO, recognized Nortel's technology gap and strategized that they must make up for lost time by buying cutting-edge startups with technology patents with little to no sales. And so he kicked off this spree by acquiring a company called the Bay Network for $9.1 billion in 1998. And then they changed their name to Nortel Networks, and Nortel continued to buy up a company's huge buying spree of $19.7 billion on acquisitions in the year 2000 alone. But rather than using cash, Nortel overwhelmingly paid for their acquisitions with their own treasury shares. And from 1997 to 2001, Nortel enjoyed a spectacular run as a widely held investment as part of the broader dot-com investment bubble right? So Nortel's stock rise, however, was complicated by the peculiarities of their accounting rules. They had to write off the value of the acquired company's assets. As such, Nortel did not record a single profitable year from 1997-2001, even though it was one of their busiest times. So what did Nortel do, Kev? They innovated their own accounting to claim profitability, of course.
Oh.
Right?
Why not?
These companies are all innovators, right? And so why not innovate your accounting techniques, right? So they promoted an accounting gimmick called earnings from operations, which ignored the depreciation and amortization of acquisitions, acquired assets, and anything else that negatively impacted earnings. On paper, they were making money, and so on July 2000, Nortel's common shares reached a historic high of $124.50 on the Toronto Stock Exchange and represented over 35% of the value of Toronto's TSC 300 index. 35%. You remember that, don't you, Kev? Like Nortel was 1/3 of the market capitalization of the Canadian stock market.
I do remember that, Patrick. And then, then the other thing was that Bell owned a whack of Nortel, and so Bell also was a big component in the index. So between the two of them, they accounted for like 40% or something.
It was some ridiculous amount. It was just one company making up the thing.
And I was doing index ARB at the time, and used to laugh because those would be the two stocks that would matter the most.
And exactly, but what's crazy was that during that time, there was a commodity bear market, so the vast majority of Canadian resource names were in the gutter. And so if you wanted any performance, in back then they wouldn't allow Canadian retirement accounts to have I think it was like, wasn't it 80% had to be in Canadian investments or a large percentage like that?
That's right. And there was a foreign content rule in a lot of the RSPs in our kind of retirement savings accounts. So the only way people got around that was to, like, if they wanted to buy high-flying.com stocks, they had to buy
Nortel. So there was shitloads of people that were like all in on this stock.
It was as Canadian as Tim Hortons.
Yeah, and at that same year, John Roth was named Canada's CEO of the year. That's the most dangerous it's the kiss of death. Everyone knows the magazine cover shit. And so so to set the stage, in a sense, Nortel had built their bridges, per se, the reference I made of that previous joke. So the reversal though began when Nortel missed its 2000 Q3 earnings, and it triggered a big sell-off. Then things got worse in Q1. They adjusted their guidance halfway through the period. Nortel stock had been around $46 after the split then they reversed their guidance, and it just triggered an unstoppable slide. Of course, John Roth quit. You got to bail out before you can't go down with a sinking ship, right? And so by June 2002. Just a few years later, in the middle of that ugly .com bust, the stock was trading at less than $3. They then filed for bankruptcy protection in 2009, and it was the largest corporate failure in Canadian history. So Nortel sold off all of its assets, $7.3 billion of it, to a number of companies that you might know. They sold their assets to Microsoft, Apple, Research Emotion, which is BlackBerry now, Sony, EMC, Ericsson. And so it was just split up and gutted to all of these other people. So after announcing its plan to sell off all its assets, Nortel shares were delisted from the Toronto Stock Exchange on this day in market history, June 26, 2009, at a price of 18.5 cents a share, down from its highs from 2000. And it was one of the greatest boom bust stories that ever happened, right?
They should have just hung tough, because in 2020, announcing your bankruptcy would cause the stock to soar.
Oh, what fools. You could have just held out.
Yeah.
But what's interesting is so the CEOs paid themselves huge retention bonuses, and in the end, something like $190 million in retention bonus or something after 2009, and basically they went after them, saying that this was all fraudulent stuff. Was there any justice? No, they all three were acquitted, and so it's just that story, right? And that's why we don't call them Nortel the equipment builders. No, that's not their names.
Well done. Brought together at the end. I like it, Patrick. There's so many stories about Nortel that I have in terms of trading, but we'll save them for another day. Maybe sometime in the summer when things are going slow and we have nothing to talk about, I'll give you a couple of different stories that I have, because there was, as you mentioned, as you said, it was a huge part of Canada, and it ended up being something that there was a lot of different trades, and over the years there was a lot of people who made and lost fortunes in that name. Thanks for sharing that all with us, Patrick.
Yeah. All right, it's time for the WTF clip of the week. Taylor, jump on here, buddy.
Hey, man, this has been a great episode so far, and thanks for having me on.
Oh, for sure. And, we were all kind of talking as to what we should do this week. And, Kev, you came up with...
I did. This is mine. And I saw Abigail Disney on TV, and she is a philanthropist and left-leaning. Oh, God, I've had too many beers. Left-leaning.
Left-weenie.
Left-weenie, wow.
She is left-leaning. Really Let's feel. Try that again. And I thought that it would be great to highlight her with somebody who might be the opposite persuasion. So I suggested to Taylor that he mix the two with some Wall Street with Gordon Gekko. And it isn't funny, but it is great.
Warning, everyone, you're not going to laugh.
It isn't funny, but it is great. That is what I will say.
Taylor, did you laugh when you were making it?
You know what? I laughed at the end, but then I found myself being like, why did I laugh there? I think I laughed because I wanted it to be funny. I wanted it too much. Okay. But not everything's a laugher. Sometimes you're a thinker. You know,
it's a thinker.
We'll see
it's a thinker.
How much you think of this one?
All right, let's play the tape.
Abigail, what's it going to take this time? Is it going to require some of the wealthiest among us to really step up and make a change? Because it is a systemic problem, as you suggest.
What the hell do you want?
We're going to have to talk about this sort of radical idea that there is such a thing as too much money.
It's not a question of enough, pal. It's a zero-sum game. Somebody wins, somebody loses. It's all about bucks, kid.
There is such a thing as too much money. 50 years of a corporate ethos, which has privileged the shareholder over every other interest inside of the company, have come together in a kind of a perfect storm.
The point is, greed, for lack of a better word, is good. Greed is right. Greed works.
We need a wealth tax.
It was well done. I thought it was really good. I liked it. I'm a buyer.
Anything with Gordon Gekko's.
For sure. And I do think it's interesting that Taylor is very enthusiastic about Abigail's politics.
I am.
Ooh. Could that be his younger persuasion?
Or could it be from my progressive upbringing and general empathy towards people? I'm not sure.
Your humanity.
It's probably just because I like avocado toast.
Yeah, that's right. Probably it.
That's probably it. It's all the avocado.
Well, listen, buddy, great job. Thank you for putting that together. That was awesome.
Of course. Thanks, and looking forward to next week.
All right, Kev. Top 3 things to watch next week. Before we get to it, let's quickly just review what we were looking at last week. And so the first thing we were talking about COVID, and nothing really happened. Did anything?
No, there was no dramatic kind of changes. So that was a dud.
It was a dud. And number 2 was that would volatility return after the quad witching roll off? And well, I think things have become more volatile, but it just we haven't seen a big break in either direction. But it looks like the market's ready to do something big. No,
I think that although volatility, we haven't had a breakdown. We have had volatility go up and down increase as stocks have been going up and down. So I'm saying we actually got that one right. Volatility did increase.
But I still think that there's a big trend move coming, and so
1 second, I'm getting told that one of the stocks actually did pop. INO, which is one of the vaccine stocks that we were watching, and it did pop that we were supposed to be watching at least, and it did pop.
Look at that!
15 to 35 and closing at 30. I know Taylor's trading that one. He's a big fan, and so there you go.
Market moving news. You heard it here first.
Except we aren't watching it, which is kind of we're falling off doing our duty.
Oh, absolutely. That's. But are you surprised?
Par for the course. Gold, breakout or fake out?
Well, we talked about it,
but it's neither yet, right? It's still in the range.
It hasn't faked out, and so it just hasn't broke. Yeah, it has. It's neither. It's neither. Right. It's one of these that we could kind of punt to one more week and see what next week brings, because I still think that nothing has changed. It would have been on our top 3 if it wasn't for last week's. It's still something that's working, and it's got a lot of tailwind behind it, and we're going to find out whether it breaks out. It's a big thing to watch.
Let's not go true.
All right,
let's go. What do we got next week?
Let's go. Next week. Number 3, Kev. What's going on here? Like
we
Powell
got
and
Anne Mnuchin speaking at the House Financial Panel. Increasingly, listen, this has become more and more important because the economy and the politics in terms of making sure that there's the fiscal and the monetary support means everything to these markets. And any hint that they're going to pull back could cause the sell-off. So although you hate to be, sitting around having to watch these things, you have to, because they are what's going to influence the market. So it is the top 3 thing to watch next week.
There you go. And so number 2 is that we have the long weekend coming. In Canada, we started off on Wednesday, and we're just going to continue for the rest of the week. But in the U.S., Friday the markets are closed. Jobs numbers are going to be released on Thursday. First of all, how typically volumes start to narrow a little bit as we go to the end of the week. But do you think the jobs numbers can move the markets in that kind of environment?
They for sure can move the markets, Patrick, but there's no doubt that a lot of people are going to take next week off. This is going to be a big holiday week. And I think that we're going to find that in that environment, if we did get a surprise, it would affect the markets even more because there aren't the kind of liquidity providers
skeleton
on
desks.
the other side.
The skeleton crews on the desks, yeah.
So you sure you got that right though? Is it? It's on the second here. I'm just looking in to make sure you got this right. Yeah, there it is.
There it is, eh?
Yeah, you're absolutely right.
I got it right.
Yeah, good for you.
Well done, right,
Patrick. And then we got the number 1 things to watch next week is global flash PMIs. The labor and the economics is somewhat backward looking, and it actually ends up being. It's important, but it's probably the flash PMIs are giving you a better sense of what's really happening in the economy. And we've had obviously this big bump from the bottom, lots of increases in terms of the numbers were so bad for so long that there was easy to kind of have a sort of a rise. Now that we have this rise behind us, the real question is it going to falter? And are we going to see the situation where these PMIs, the kind of the high frequency numbers, start to roll over? And that's what I'm watching for next week.
Well, there you go. Those are definitely 3 things to watch in what will be. It'll be interesting. It'll be low volumes, a lot of skeleton crews on the desks, and a lot of things that could potentially move the market. So it'll be interesting whether things start to roll next week.
Low volumes doesn't mean low volatility, Patrick.
That's right. And so let's get to the parting words of wisdom. What's going on here, Kev?
So we got Michael Marcus, who's a very famous trader from Commodities Corp, and he says that being a successful trader also takes the courage to try, the courage to fail, the courage to succeed, and the courage to keep on going when the going gets tough. I felt we need something. Something inspirational.
It's impossible to be a successful trader over the long term and not get into losing streaks and periods where the market's just not, things aren't working, and you have to be able to persevere through it, because otherwise it's very hard to do this career for a long time, right?
It is very difficult if you don't have the perseverance and the willingness to just keep at it. So if you're having a tough trading week or month, just keep going. It'll get better. Unless it doesn't, and then you're spent to do
and then you're done
else.
anyway, so it doesn't matter.
Yeah. Well, that's it for our main show this week. We appreciate you all tuning in. Oh wow, I did a y'all. I didn't realize that. That's a new one for me. We couldn't do the show without you. I'd like to thank Victor Sperandeo for coming on. That was a terrific interview. It was really interesting to hear the 5 decades of wisdom that he brings to the show, and it was really an honor and a privilege to have him on. And if you'd like something with this, if you liked our show, please share it with your friends. You never know, the bigger the following, the better chance we have at getting Warren Buffett to spill the tea about his infamous morning Egg McMuffins. Ketchup or no ketchup is what everyone's asking. Before we get to the after show, here's where you can find us. You can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. And a lot of people watch on YouTube to see all the charts and visuals. And while you're there, please like and subscribe to get our latest content. Follow us on Twitter at The Market Huddle. We're on Twitter every day. Give Lena a shout out. And please, if you could, rate and review us on iTunes. It helps us out immediately. We'll try that again. Lena.
Will you?
Yeah, let me just edit there, Lena. And please, if you could, rate and review us on iTunes. It helps us out immensely. Where can they find you, Patrick?
You can find me on Twitter at Patrick Ceresna, and you can as well follow me on my website, bigpicturetrading.com. Kevin, where can they find you?
Well, they can find me on Twitter at Kevin Muir, M-U-I-R, or my newsletter at themacrotourist.substack.com. And listen, you can never have too many friends. Bear market, bull market, we're just happy to spend time together on this crazy ride. So thanks for everyone tuning in. Now stick around for the after show.
All right.
Okay, the youngins, hop on.
The youngins.
Not that much younger than you.
They're young. Makes us sound old, I know, but different generations. I'm not going to say
you're the one that's pointing it out. You're the one that's pointing it out.
Okay, that's fine, but I just like calling them
out.
the youngins. It makes us seem more hip than we are. The fact that they're elder millennials.
You're not.
Yeah.
Kevin, you're not really hip and cool until you buy like a funny T-shirt off Instagram.
Really?
That's yeah. I don't know. I don't know if I'm hip and cool.
I see this Portnoy guy, and he's wearing the what is it? Saved by the Bell, the dark-haired woman, young lady, or teenage star. I don't know whatever her name is.
Oh my gosh, what's her name?
And I think it was kind of ironic.
Kelly Kapowski.
There you go. He's wearing a Kelly Kapowski shirt. I think he's cool. I can't wear that though. I look like a pervert if I wear that. Seriously, yeah. I'm almost 50 years old. I look like a pervert if I wear that. It's just unfortunately.
Just wear it around the house.
Yeah.
Yeah, just around the house.
Yeah. My wife and my daughters aren't going to look at me weird at all. Like, what are you wearing, Dad? I'm like, well, Kelly
Switch out your
shirt.
Tommy Bahamas for a Saved by the Bell T-shirt.
Yeah. Well, anyways, that's just life. Do you guys watch this Dave Portnoy guy on a regular basis? I do.
Well, whenever you tweet something, I follow.
It's entertaining as hell. It's entertaining.
He is funny.
Oh, and he's gotten himself kicked off of E-Trade, which is just hilarious. Like, how bad are you that you get yourself like, no, we don't want your business anymore. Screw off. Like, that's what happened.
Really?
Yeah.
Wow.
Yeah.
Yeah. It's. I'm actually like, I don't know how he. I don't know. Is he like? I can't understand why he's so good. Is he good? Is he killing it, or is he just really entertaining to watch? Because it seems like he does very well. And is it the beginner's luck thing? There's this.
It's not. It's a self-fulfilling prophecy. When you can front run everyone.
No, he's trading big stocks, and he's not like. I disagree. He's actually nailed some trades. Everyone else was scared to buy the the airlines, and he bought them. He nailed the trade. Now, whether he gets out in time is another story completely, like a different story. But I really think that he understood that, and he had the balls to go for it. So I disagree that he's front running his own trades. I remember watching him. He had no idea that he could even move a stock. He mentioned something, and the thing started running, and he was confused.
Yeah, we made a
that's right. You
WTF
made the
video
WTF.
about it.
Yeah.
Yeah, that's exactly
Kev,
it.
don't you remember being there?
I do remember. But
Kevin, you remember?
But I don't buy that he's this guru that's
no, I don't think he's doing it intentionally.
Buying a stock and then selling
listen,
it
you
when
create
he
enough
tweets
buzz
it out.
about anything. It's what the that's the art of the Wolf of Wall Street. You just got to create buzz about anything.
Not only that though, but Patrick, one of the other things is his volatility is through the roof. Like, I don't know how much he's trading with, but he's going up and down a quarter milli, as he calls it. So unless he's trading with like $100 million, then he's going up and down too much.
Yeah.
Right?
Yeah,
his volatility
I think sounds like he's like a big. It sounds like he's got the mindset down. Like, it's really he's just he's got the volume to play mindset properly, but I'm not sure. It's interesting. I
think that what he has going for him is a certain street like shrewdness to him, and I do think he has that. He's figured it out. Then the other thing is, even if he loses, it's worth the publicity to him. So let's say he loses $1 million. What would he pay for that publicity? There's a good chance he might have paid $1 million. So instead of going and spending $1 million on advertising, he's just throwing it around on the stock market and getting that advertising there. It's almost genius in a way. It's like Donald Trump did when he would go say crazy shit, and then everyone would report on the crazy shit, and he would get himself in the news. And if he wasn't doing that, he wouldn't be in the news. Nobody would be talking about it. So we're kind of almost like fools for, with Donald Trump when he says something crazy of not just ignoring him. But he would say crazy stuff so that you go, instead of buying all that advertising, you just go say crazy stuff. And it's the same kind of concept. The real question is this going to like wear itself thin with a lot of people as this continues, as people do this more and more? Or is it just human nature and we're always going to fall for it? I don't know.
You know what? It sounds like he needs a manager. We should be his management team. We'll go in there, hang out at the mansion, at the pool, drink the bevies with him, and just give him some advice. We'll guide the ship.
There's a solution.
I think he's doing more than drinking some bevies, though.
That's okay.
Yeah, I think he's got some. He's got a lot of energy.
Other forms of
say.
entertainment.
He's got a lot of energy. So I don't know. Let's talk about something else. I'm always accused of talking about him too much.
We got to do the beers before.
Oh
to do
God!
the beers.
Thank God, Lena. Let's go over here. I almost called you my wife's name, which is better than the other way around. Okay, let's do this. Patrick, you start since you're the big fan of the Berry White. Raspberry wheat.
It is a nice summer drink. I envision when I think of this beer, it's like having a Corona with a lime. You can have one, whether you want a raspberry twist or a lime twist in something. It's a perfect summer drink. I give it an 8.5 for the summer, 7.5 for a winter drink.
God,
oh, wow.
Lena.
I actually quite liked it. Actually.
Boom.
But
eat that, Kev.
Here's the thing, though. I didn't think that this tasted like a beer.
Exactly.
It was, like I said earlier, it tasted more like juice, but it was good. I do agree that it's a good summer drink. I think I can probably drink a 6-pack of this.
Okay.
For sure.
So what do you give it?
I would probably give it. I would give it 8.2.
Oh my God. Okay. So if I was trying to get my like an 11-year-old drunk, I'd give him this because it tastes like grape juice, like our raspberry juice, as you mentioned. If this is supposed to be a beer, it is not a beer. It doesn't count as a beer. I am giving this a 3-1.
But it was that bad.
But
I think
it's
it was
not
good.
a
It just
beer.
didn't
It's
taste
not
like a
even
beer.
pretending to be a beer.
You know what it tastes? It kind of tastes like it could be a version of like Mike's Hard Lemonade, but like a raspberry version.
That's right.
You know, like a cooler almost.
So if we were doing coolers,
beer. What are you
if we were
talking
doing
about?
coolers, then I'd rate it
Oh
better.
my god.
So there we go. 3-1, lowest I've ever given.
I'm not drinking these days, but all this beer talk makes me think I'm probably going to start up again. But in the meantime, I want to give a little PSA about these. I'm not drinking beer, but all I've been thinking about are those. I don't know if you guys had them. Turbos, rockets, whatever you want to call them. It's Smirnoff Ice and beer served over ice.
God.
Do you guys remember? Have you guys had these?
No. That sounds
Okay.
terrible.
I know it does. But
Comes with memory loss, just so you know.
Yeah. For all we know, Kevin, you have them all the time. You drink them all the time. You just don't remember. They are like, it sounds crazy, but like grab one of your wife's Smirnoff Ice that's kicking around, and do half and half of the beer over ice. I'm telling you, it's gonna change your summer, and you will be on board, and you'll sound just like me.
You know what? My brother-in-law drinks those on the golf course. It's I've heard now that you're mentioning exactly that. That's exactly what they drink on the golf
I don't know.
course.
Taylor
But
says
I
he's gonna.
haven't-
Taylor says he's gonna start drinking with us. I don't know if I want him to. Like, this sounds terrible. Like, this is. Lita was kind of holding me in there in terms of these non-fruity drinks, and now we're mixing it with Smirnoff, and like, this just sounds bad.
I'm just without this booze, I'm just going back to all the, these back in engineering school, these drinks called the Billies, which are like, beer, a little bit of orange juice, and then I think it's whiskey and amaretto, and it's 4 drinks in one, and you drink it, it tastes like juice, and then next thing you know, you're face down on the floor yelling at everybody.
So Taylor's an engineer, which is awesome, and engineers are obviously huge drinkers. I would like to tell you about my favorite engineering story. You know what the Century Club is? Did you guys play that?
Oh yeah.
Yeah?
Oh yeah.
Okay, so everyone, for those who don't know, you got to drink a shot of beer every minute. It doesn't sound for 100 minutes. It doesn't sound that tough, right? Like, it just doesn't sound that tough. It is.
It's tough.
It's not easy at all, and
because you're not allowed to go to the bathroom in between.
well, that's strict rules. But anyways, it depends on whether
no,
you're
that's a no, but it is, and that's actually one of the parts that is the hardest to achieve, right? Because once you're having 3, 4, 5 beers in your stomach, gravity takes over.
Gravity.
Well, so where it depends.
Oh my God!
Wow, that's genius.
That's part of the rules that you can't go to the washroom. I thought
You can't.
It's like 6
No.
pints. Oh really?
Well, every time
I don't know.
played,
We called that strict rules. That was like you could play Century Club and you could play Century Club strict rules. So we had different things. What I was going to tell you though.
Yeah, but nobody has to know if you're wearing Depends.
Yeah,
You
Lena,
don't
you're
have to
just
do
way
that.
too into the Depends.
Yeah.
I met these engineers in university, and they played the Bicentennial Club strict rules, and they made it, which I thought was outstanding because a lot of people don't make it; they throw up. It's a difficult thing to achieve, especially when you're
What is
like
that
18,
version?
19, 200.
Oh my God.
Strict
That's
rules,
a
no
lot.
peeing.
Oh
That's
my
like
God,
when my
You have
eyes.
to train for that shit. Like people train for marathons, you have to train for that.
Well, I think it's just engineering.
You can't just
engineers.
do
It's just
that.
like self-selecting. They're tough.
Yeah.
They're just like it's just self-selecting. That's how engineers are. They're different.
Yeah.
They're not like us
I
finance
never-
guys. They're way tougher.
I don't know. There was always this pride in that, like they would just, chum out with the boys, and then no one could talk to a girl. Like it just killed me. I was like, hey, let's go talk to them. They'd be like, oh, cheers. Like, what are we doing here?
No talking to the girls.
What's the fun in
Jesus.
that?
It's like grade 6. Stay on our side of the gym.
Yeah.
Taylor, you were going and trying to talk to the girls. Get yourself
I know.
ostracized amongst the engineering community.
Jeez. I know. It was
You guys
just too
are
much.
funny. You guys are funny.
I don't know if you remember Edward 40 Hands. Did you ever hear of that?
Yes,
Kevin?
I have. Yes, I have heard
Yeah,
of it.
you tape the 40s.
Okay.
Yeah.
Yeah. All right.
But you do it only in one hand the 1 years? Because I know a few that did the 40 in each hand taped.
Yeah.
Like, that's hardcore shit.
That's like, you're going to die. That's pretty stupid.
You're going to die. That's
It's pretty stupid.
I feel like I'm gonna pass out just hearing about it.
Yeah.
it's
It's too
But
much.
those are
you know who's a
engineers.
champion? You know who's a champion of that is Jon Snow there, Kevin.
Oh,
from,
yeah. So
yeah,
Jon Snow
he's
is
an
this fellow
engineer.
that went. He's Patrick's friend, and he was a young fellow, and I took a picture beside him.
Millennial.
And yes, and he was. I decided I was never going to get a picture taken beside someone so young and good looking in my life. 'Cause I look like this like. I was like, what the fuck? I'm like, beside this young, good-looking guy, I just look old and wrinkly and bald, and like I was like, just. And these guys are passing around the picture of us. I was like, don't do that. That's not nice. That's my man.
But anyway,
crush.
oh, there you go.
Yeah.
All right, guys. I'm tapping out.
Okay, well, that's it. Everyone, have a great weekend. Thank you very much for listening. Make sure you tune in next week. We got a lot of great shows planned. Thanks for bearing with us. And
Yeah. Oh yeah. Listen, we're releasing early next week, aren't we? Because of the long weekend.
I don't have any clue what we're doing. I'm not in charge of that.
For all our hardcore listeners, there is a chance that things may happen sooner. I don't know.
I doubt it.
No promises.
Yeah, don't do that to poor Lena. It's coming out
I don't
Saturday
know.
morning.
I don't know.
It's coming out Saturday morning. It's going to be a good one. We have a good guest.
So-
Stick around.
The announcement is no announcement. That's the announcement.
Yeah,
we
there
got some
you go.
big news.
That's right.
We can't tell you yet,
You'll
but
find
it's
out
coming.
next week.
Okay, that's it.
Well, I'm glad we planned this one out
Yeah, I
before
know.
we talked about it. This
right.
went really well. All right.
Yeah.
Have a great weekend, everyone.
Bye-bye.
All right. Thanks. Cheers. Bye.